we've been deploying aggressively over the past few months. And there are better opportunities now than there have been in my 4 years in the space. That is the reason that I think we're closer to the end than the beginning. And I don't know if this is over in 6 months or in 18 months. So I don't want to, call a date here. The regulatory environment that did not let us operate is gone, and you're already seeing the benefits of that. And we're seeing people build businesses on top of this, right? Like stables are growing, RWAs are growing. There's leeway to do a lot more. Large institutions are interested. All the typical things that we talk about, those are all real things, right? Where founders are able to experiment, build products that aren't just meme coin casinos, and actually build real businesses that can grow for 20 years.
Nothing said on the Edge podcast is a recommendation to buy or sell tokens or securities. This content is for educational and entertainment purposes only. Nothing shared here is financial advice.
Welcome to the Edge podcast. I'm DeFi Dad here with Nomadic. Today's show features Felipe Montealegre, founder and CIO of Theia. Felipe, thanks for joining us. How are you doing?
Good. Thank you for having me. I've been a long-time fan of the podcast.
Felipe, it's awesome to have you on. I think I started seeing your work from Theia. I don't know how long it was, like how many years ago now, but there's this tweet that's burned into my brain. I don't know who wrote it. I don't know if it was in the last cycle or last bear, but it was like crypto Twitter has very few people doing primary research and thousands of people just parroting ideas and narratives kind of on the back of somebody else's work. But it's a very small list of people who I think actually contribute to new and fresh ideas in the space. Maybe that happens in every industry. I don't really know. But I feel like you guys are one of those few that are actually churning out new and interesting ideas for the space and thinking about things in a thoughtful and interesting way. So I want to get into more of that thought process, some of your new ideas that you've been writing about, and sort of like everything in between. But maybe for starters, we should just introduce you guys to everyone. Like, who and what is Theia? How did it form? How did you get started in crypto?
Well, thank you for the kind words. And really appreciate that. So Theia is a liquid token fund focused on fundamentals. We've been around for about 4 years in the space now, investing primarily in small cap tokens where we can build really, really good relationships with teams and kind of help them in the business formation process. And what I mean by that is, you see a lot of investors on the liquid side who are essentially macro or narrative traders, where they're trading liquidity, they're trading flows, or they're trading Twitter narratives, right? That's probably the prevailing way of investing in the space, at least 4 years ago was. We're more focused on what I would call traditional investing, where we find a good team that's kind of fintech growth stage quality, find a token that is the main beneficiary of business growth, which isn't always the case, and then and a business model that you can underwrite to. And like when I say underwrite to is a business model where you can generate so much cash in year 3 or year 5 that you're kind of paying your purchase price over a few times. And those opportunities have been, somewhat rare over the past 4 years, but they've been around in the space if you've been looking for them. So that's right. So we're a team of 4 people now based in New York doing this liquid token investing full time. And I would say primarily focused in DeFi because our kind of grand thesis on the space is the idea of the internet financial system. And we think we are still in the first inning of what's going to be a 20-year process where the entire global financial system transfers from traditional kind of siloed servers around the world to blockchain-based rails.
So we just recently had on Davide Krapis, who is the AI lead at the Ethereum Foundation. And we were talking about this intersection of AI and DeFi and talking about just the impact of LLMs. We know you guys have written quite a bit, or at least talked quite a bit about your habits with using AI tools. Before we, again, talk more about how does AI fit into your thesis for liquid token investing, just curious, like, what are your thoughts on some of the AI tools out there? Like, what are your habits? What are some of the tools you like to use?
Yeah. It's we've been posting a lot about it, like almost everybody else. It's really been a fantastic accelerant for investors, and especially small funds like us, because a lot of the job that I had previously when I was doing kind of mid-market private equity before this role was was knowledge creation, where, you get an industry assignment, you'd have expert network calls, you kind of go through the financial documents, build a deck together. But like getting a bar chart on some industry growth driver was like a 4-hour assignment, right? And at the end of it, you'd read your deck at the end of like 3 weeks of work, and you'd be like, oh, that's interesting. I put that together. Now you've compressed that time massively, where you can just be doing really, really high quality research and analysis, in minutes as opposed to days or weeks. So we've been taking advantage of that, like every other investor. We use, I think, pretty typical tools. Like I use a lot of Notebook LM to summarize podcasts and articles. So I'd say maybe before, where I can get through, 10 articles in 2 hours. Now you can get through them in like 15 minutes, because you kind of just say, hey, what are the 5 most important points here? And if anything's interesting, you double click into it, right? But the reality is that in investing, most of the stuff that you're reading is that you're rereading an idea that you already know, right? There's a lot of like that dead weight reading time where it's like, oh, you're reading about the thesis with crypto at the beginning of an article. It's like you read that 1,000 times, right? So kind of cutting out that repetition time is just really valuable in turning over more rocks, like just getting through more content. On the modeling side, I think what we're doing is more original. I think, at least in my mind, we started the fund actually before ChatGPT came out with the idea of doing everything directly on Python, because we had this idea of like, oh, we're doing investing in crypto, data is live and streaming. So instead of building models in Excel and PowerPoint, where like a model is static and you need to update it every few weeks, why don't we build models in Python where whenever we need to rerun the model, we just hit refresh, right? That was like our insight 4 years ago. So like we learned to code, we hired an engineer, and like we went through the really painful process of abandoning like 10,000 hours in Excel and kind of just building everything into Python directly. Then obviously, ChatGPT came out, and now Claude Code came out. So our process of running models and doing modeling assignments has gotten like 100 times better and 1,000 times faster over that period. And those aren't even like exaggerations on the definitely not on the timing part. 1,000 times faster is probably an understatement. So now, we can find ourselves building 5 good models a day if you're focused, if you have 2 cups of coffee. And you can even create models that have been known to be like theoretically very sophisticated ways to model financials, but weren't possible before. Like the one example that I'll give is the Monte Carlo simulation. Like I used to pretend to do Monte Carlos in my old job. People would be like, hey, run a Monte Carlo for this. And just to pause for a second, Monte Carlo is a model where instead of an assumption, instead of saying like, I think TVL will be $1 billion and interest rates will be 7.5% and take rate will be 10% of that, you make a distribution for each thing. So you do a whole probability distribution where you say, well, I think that the TVL is actually a bimodal distribution based on the market environment. And I think that it's probably interest rates are probably log normal between with most mass between 7.5 and 12.5 because of these 3 reasons, etc. And then from those distributions, you actually sample, you run 100,000 samples of the distributions, and then you get a distribution model output. And I think that's obviously a really nice, I'm going super deep on the Monte Carlo, so I'll come up soon, but like, that's really nice because for one, like you get to think in distributions, which I think is the correct way to think about investing and like the uncertainty about the future. And 2, you get to reflect those distributions in your actual like output. So your model outputs are no longer like this company's worth 50, it's this company's worth this distribution. And maybe 50 was the mean. But anyway, so it's like there's all these types of models that are not possible with LLMs that were not realistic before when you didn't have this kind of computation power.
Yeah, no, ton of good points in there, Felipe. And you were just making me think. So DeFi Llama came out with Llama AI, and I've been using it a bit. And man, to your point about how much time it saves. So again, I've always been a fundamentals investor since I came into crypto. For better or worse, it's been, it's been brutal for us fundamentalists, but not anymore, fortunately. But anyways, I was using Llama AI, and I was like, okay, like tell me the top 10 protocols that have generated positive revenue month over month the last 5 or 6 months or something like that. And this would take days and maybe weeks to get the proper data. Like, again, you can still question if the data is proper, but you're getting into the, you're getting such a better benchmark now, like, and it's happening so quickly that, you know, it just raises to the top things that you should be looking at much faster and much more quickly. So you also spoke a ton about models in there. I want to talk about a different type of model that you also write about, which is mental models. Maybe just speak a bit about your passion, it seems, with mental models and how you apply these to crypto and investing.
Main Street brings the options box spread to DeFi, a proven delta-neutral strategy. Paired with Accountable's real-time proof of reserves, MSY captures a multi-billion-dollar source of TradFi yield and redirects it on-chain. Institutional yield now built for everyone. To learn more, go to mainstreet.finance. In DeFi, yield shouldn't come from chasing dashboards or timing markets. KPK runs non-custodial vaults and on-chain funds built for stable, risk-adjusted returns. Capital is allocated across curated strategies and managed by automated agents that act within seconds under predefined controls. No custody, no manual intervention, just disciplined execution on-chain. If you're allocating capital and want sustainable yield with stronger controls, visit kpk.io. In DeFi, most stablecoins ask you to trust them. Trust the collateral, trust the peg, trust the managed risk, but Noon proves it. The stablecoin built for the highest yields, highest returns, long-term. With transparent reserves, real assets, and delta-neutral strategies, access real yields in real time. To learn more, visit app.noon.capital/vaults. Accountable is the new standard for real-time financial verification. In crypto, financial health still runs on screenshots, lagging audits, and blind trust. But Accountable changes that. Powered by the Data Verification Network, it proves assets and liabilities privately across wallets, exchanges, custodians, and banks. Accountable already secures over $2 billion in verified assets across 115 chains and over 90 data sources. To learn more, go to accountable.capital. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
Yeah. I think those two things are related, by the way. So about 10 years ago, I heard this speech from Charlie Munger where he talks about kind of the education of a good investor. And his point in the speech was that most disciplines have a few good mental models, and that's most of the value of studying that discipline, right? So like if you study economics, you know, kind of thinking about marginal cost, marginal revenue, supply and demand, the Gordon growth model. I studied economics in college. There's like 15 good models in there. And if you understand those, you got most of the value from that major. And almost everything else is really not as important if you're not going to be a practitioner of the craft. And that resonated with me. I had a pretty liberal arts education where like I took 10 economics courses, but then everything else was like sociology, philosophy, physics, etc. So the idea really resonated with me, and I got kind of this OCD obsession with coming up with like the definitive list of mental models, which, you know, turns out it's not fully possible. But what we ended up with was a list of 700 mental models that we use internally at Theia that have kind of been hunted and gathered over those 10 years. So, you know, I encourage everyone to check it out. That list has models from economics, from financial markets, from game theory, from, you know, math. And it kind of skews towards more of a financial services investor, because that's what we are ultimately at Theia. But it's a really good list. You know, maybe I like to make things concrete. I'll talk about some models that we have in there. Like one is Page's diversity prediction theorem, which is just the theorem that adding predictive models that are uncorrelated and averaging them out tends to give you a better result than even the best predictive model. So, if you have an investment committee with 10 people and one person is the smartest person on that team, having a discussion with all 10 people will still give you a better outcome than just having that one person give their opinion. Because the other people on the team will all add information. They'll add bias and error as well. But the thing is, if they're truly uncorrelated, the error cancels out, but the information adds. So that's like, this diversity prediction theorem is it's a mathematical theorem, but the application to investing is obvious. And obviously this can apply to any field. Maybe I'll just give one more example, just to kind of make it really concrete. We think a lot about like optimization, right? Like, how do you optimize our business strategy, our portfolio, my life, my time, all these things. And there's this model of like, what kind of optimization landscape do you have? Do you have a Mount Fuji? And a Mount Fuji is just like a mountain that goes up and down, right? And that's like pretty basic. Like the width, the length of a shovel is a Mount Fuji optimization problem. If you have a really short shovel, you're not getting any torque on that thing, and it's too short. You're not going to get a lot of work done with that shovel. If you make it really, really long, obviously the shovel is impractical. And then you can just keep making it, start with a really small shovel, make it a little bit longer, measure the output, and you'll see the point where it peaks, and you'll see the point where it starts going back down. That's like classic 101 optimization. But most of life isn't Mount Fuji optimization, Mount Fuji landscapes. Most of life is what we call rugged landscapes, where things just really kind of bounce around, and like, just moving one variable won't get you to the right outcome. So like, a good case here is like the design of, the design of a room, like adding more sofa. There's not like a right amount of sofas to add to a room. I've never used this analogy before, but like, it depends on what the room looks like and what else you have in the room, and is there a dining table in the room, or is there a TV in the room? Everything interacts with everything else, right? And I'd say much more of life is this kind of rugged landscape, but then there's a third landscape, which is the dancing landscape, where not only do you have a rugged landscape where things really are not linear in optimization, but they're also moving around. And investing is actually that third problem, where like investing in business, right? Like, what is the right amount of borrowed land exposure to have versus DEX exposure? That's not a problem you solve in 2023 and kind of set it and forget it. That's a problem that's moving every day, because valuations are moving, market conditions are moving, teams are changing, the future, regulations are changing, everything's changing. So you have to really think of optimization not as something you can set and forget or think about statically, but something that you're wrestling with this kind of dancing landscape problem every day. So again, just like one example of a mental model problem that applies as much to physics and design as it does to investing.
So we'll have to link in the show notes this post with the 700 plus mental models. And, in all truthfulness, I haven't read it myself, but I really want to read it now. One mental model that was top of mind for me in the space is that L1s would accrue all the value, the fat protocol thesis. This idea that like everyone would build on L1s and they would accrue value. And I'm curious, like, any thoughts on that? Like, that seems like one of the mental models that's broken, and it's leading to a lot of upset feelings, chaos, like actual blowups, and funds actually failing in the space.
It's led to a lot of pain, right? And I think that's the reason why you want to have the 700 models and not 5 or 10, because there are oftentimes many mental models that apply that could be applied to a situation, but not all of them are true, right? But all of them could sound true. And that's why you get to this idea of kind of perspectivism is what we call it. That's not the official name, but like, you want to have multiple perspectives of the problem and really have them wrestle each other in good faith, and kind of like, and kind of debate whether, and try to find the truth that way. We were really open to this L1 valuation model when we started in the industry. We were hesitant, but we also had a competing mental model, which is DCF, right? Tried and true mental model of how financial assets are valued. And I think there was a good 24 months where we were honestly debating those two internally. And always on the side of the DCF, I'd say, with the bias there, but really giving each model its fair steelman. But ultimately, we came from the view that this industry was not different, except for a few select assets, which I think is what makes it so hard, right? But that almost every asset in the space, and I would say almost, I mean 99.9% of assets by number in the space, will be valued on DCF. And that's the reason we've avoided basically every L2, every Alt L1, every kind of narrative investment that's trading at like 10,000 times 3-year forward revenue, because ultimately we went with the DCF mental model, which is assets are valued according to the discounted value of future cash flows, right? And if you can't give me a model where this asset is worth its valuation by future cash flows, a credible model, right? A credible model that you can show me, and I'm talking about financial model, show me in good faith and not laugh, then it's not an investment for us. And I think, the point that you mentioned is that it's led to a lot of pain and blow-ups, and it's also frankly led to terrible industry morale, right? Because we have now kind of expunged that mental model through price action instead of through like honest debate 4 years ago. And it's caused us to go through this 4-year bear market in the token space, which was warranted, right? Because if you started in the space 4 years ago, valuations were insane by any kind of standard if you believe in the DCF model of the world, right? And the token holder protections problem was unaddressed, fully unaddressed for anybody who believes in the DCF model of the world, because you have to get the future cash flows, right, for the asset to be worth anything. And what we've seen over 4 years is that people who have invested in tokens at high valuations without protections have lost money. So they've left the space, or they've had capital pulled from them, or they've stopped acting like long-term investors and instead become mercenaries who try to extract value from the ecosystem. That's also been an exit path, so to speak. But what you're left with is nobody who wants to hold the vast majority of these tokens. And mechanically, more sellers than buyers, so it leads to price going down. And price going down leads to a morale problem. And I think we're now towards the end of that, honestly, because we track the valuations in the space and because we track kind of token holder rights, we've been able to see how much better it's gotten. Because the flip side of the pain is the response function, where teams who want to have tokens say, hey, I need to give proper protections to the token because I want to have a token that trades well, right? And is a benefit to my company, not a liability. And investors who are raising capital now are investors who say, hey, I'm investing in the future cash flows of this business. And that, because that's what's done well, and that's what survived over this period. So I do think that the wrong mental model led to a prolonged period of pain and a low industry morale. But I do think that ultimately the truth has a way of winning out in financial markets, especially liquid financial markets.
There's so much in there that I want to get to. Just even talking about people maybe chasing the wrong model. Then you've got this whole cohort of people just chasing things that aren't even attached to a model, like meme coins and just things with absolutely no defensible, value. I don't even want to go down that track right now, but just a ton of reasons for people to be like, sort of battered and bruised right now. But you also mentioned this end of the bear market. I want the 4-year token bear market. I want to get to that at some point too, but you mentioned token holder rights a bunch of times, and I want to define further what token holder rights means for, maybe for you, Felipe, and for your work at Theia. Like, define what it means, and then what are the traits and characteristics that you are looking for with, say, a token that has strong token holder rights?
Yeah, and I think at a basic level, it means that the token is the instrument that benefits from industry growth, in the same way that public equity is the instrument that benefits from company growth at Amazon or Apple or Google, right? And, effectively, U.S. public markets are amazing, unparalleled historical event that we can learn a lot from, right? And the protections that are given to equity holders are the protections that we want as token holders. What that means, first and foremost, is not having a dual token equity problem. So if you have a token that also has an equity problem with investors, an equity stack with investors, you will, in every case, be a junior instrument to equity. And just think about this from the perspective of like, if a company launches a new business line, why would they give it to the token instead of giving it to the equity? If the token is acquired, why would the funds go to the token instead of going to the equity instrument? That's the thing that we avoid at all costs, right? Like, and I think we've been talking about this for a while now. Those are the two main things, right? Like if you're acquired, who does the money go to? If you launch a new product, who does the money go to? And if you do incredibly well and become a $500 billion company, who does the money go to, right? Then there are smaller things that really matter as well, which is like minority protections. Are minority shareholders treated well in an acquisition, or can majority shareholders always get what they want? Do you know if the team is selling? That's something that is really important, right? Because you don't want to buy a token on a 10-year view, or a business on a 10-year view, while the CEO is selling his entire stake, right? And like in equity markets, that doesn't happen because you have 8Ks and you get to know when the insiders are selling. But in token markets, that happens way more often than any of us care to admit, right? So it's all spans a whole gamut, but those are kind of the important things. That's getting a lot better, by the way. If you just want to like pause on that, I'm really encouraged by what's going on. It seems like in this latest kind of capitulation in the market over the past few months, teams have made a choice whether they want to be token scammers and kind of sell the company and not give value to the token, and do something that I consider to be deeply, deeply unethical when you're talking about people's savings in the token on tokens, or whether they want to go ahead and do the right thing for token holders and their businesses and kind of like treat the token holders like participants in the business, right? Like equity participants in the business. And you're seeing that with companies. You're seeing that with Morpho, Uniswap, Aave are three huge cases, right? Morpho to the structure where their equity is a not-for-profit that can only exist to benefit the token. Uniswap had the unification proposal where they got rid of their front-end fee that was going to equity and started directing economics to the token. Aave, with this recent drama, a big part of it is that Aave Labs is giving up all future revenue from any Aave products or additional products and committing to giving all future revenue to the token. And you're seeing that at a smaller scale too, right? There are dozens of companies right now that we're working with which are publishing their own versions of the Morpho structure or launching on MetaDAO, which is another way to tackle this problem.
Felipe, what about, I don't know if you would have seen this news in the last few days here, but we just did an interview with Hart Lamber from Across. This is a very unique situation. And by the way, we're not investors in Across. We don't hold the ACX token, but it is interesting to me that they are proposing the idea of converting tokens back to equity. What are your thoughts there?
Yeah, look, I'm not that close to the situation, but from the outside, the price went up materially on the announcement, which I think is a really good sign because it tells me that no matter what other constraints they thought of, the Across team thought of the token holders and their accretion as a constraint, right? The token going up on the news tells me that it's a better deal than the token holders believe they had prior to the announcement. So that's, again, my takeaway from that is that Across is treating token holders well, which is what I really care about. Now, they also mentioned that it's easier to run a business with equity than it is to run a business with token. And I think that is true today, right? The token space, there are a lot of advantages to having a token. But today, because there has been this long token bear market, because there have been so many people who treat tokens as a way to exit businesses and as a way to scam retail, there is a lemon problem with tokens, right? Where the best businesses, the people who are most well connected, rather get venture funded and be private, and then eventually IPO if they can. And it's only people who are kind of outside the US or don't have the same VC connections or don't have the ability to go through that path that launch tokens. And that's definitely not true in every case, right? A lot of the best businesses on chain do have tokens, but it's true in the overwhelming majority of cases. So what you have is this lemon discount where the equivalent token trades at a lower valuation than the equivalent equity. And that's a very serious problem because it's a vicious cycle. As long as tokens trade at a discount, the best founders will not launch tokens. As long as the best founders don't launch tokens, tokens will continue to trade at a discount. And that's why some of these attempts like the Blockworks Tokenholder transparency, DeFi Llama, which you mentioned, added a Tokenholder transparency piece, MetaDAO ownership coins, these transitions by Alvin Morpho, Uniswap, and many others, they're so important because I think ultimately, if you don't solve this problem, if you don't solve it quickly, you'll see more situations like Across, and the entire token space will collapse. And I don't want to be I'm actually not a doomer ever, but this is a serious problem. I think if tokens go away, I don't know what we're doing here. It's kind of like Bitcoin and stable coins. I came into the industry for the vision of global permissionless capital markets where you can fundraise from anywhere in the world and you can direct capital flows across borders, and this kind of beautiful system where you had hundreds of thousands of financial instruments that people were diligencing and that were kind of helping capital formation across the world. And without tokens, we don't have that. We have some kind of grafted on equity, tokenized equity thing, which is just not exciting, right? Relative to the vision.
I want to get more into MetaDAO as well, but again, I want to circle back to this token bear market idea. You've alluded to it being over or nearing an end, I should say. I don't want to put words in your mouth. And it seems like you're tracking a bunch of things to give you this insight or this information. So I want to give listeners maybe, something to hope for here. And of course, this is not financial advice, but I would love to kind of know what you're looking at, what, little sort of knobs and levers you're pulling over there on your LLMs to tell you that, hey, things are looking better. And kind of just more indicators that you're looking for to start really jumping back into the market, and maybe you are already.
Give us some hope. I'm a father of 3. I need some optimism here.
I'm a recent father as well, so also need the optimism. No, well, we've been deploying aggressively over the past few months. Never too aggressively because you have to be careful, but we are deploying, and there are better opportunities now than there have been in my 4 years in the space. And I think that is the reason that I think we're closer to the end than the beginning. And I don't know if this is over in 6 months or in 18 months. So I don't want to, call a date here. But basically the conditions for a good market, for a healthy market, are 1, reasonable valuations, 2, instruments that work, and 3, a long period of revenue growth for the underlying businesses. So I think the valuations have been beat down so far that they are now much better than they have been in the past 4 years, and in many cases cheap, right? Like many things are cheap now in any kind of good outcome for the industry. 2, the tokenholder rights problem, which we've gone over in detail, is being solved. And 3, most importantly, the regulations are moving forward, right? Genius passed. There's some probability of clarity passing, which is at least a reasonable probability for world from where we are today. And the regulatory environment that did not let us operate is gone, and you're already seeing the benefits of that. And where we're seeing people build businesses on top of this, right? Like stables are growing, RWAs are growing. There's leeway to do a lot more. Large institutions are interested. All the typical things that we talk about, those are all real things, right? Those are all real things, and founders on the ground are taking advantage of that to build businesses. So the last ingredient of a healthy market that can go up and to the right over time is just revenue growth, value creation at the business level. And we're seeing green shoots of that right now on the ground, where founders are able to experiment, build products that aren't just meme coin casinos, and actually build real businesses that can grow over 20 years.
So given all you've shared on this like token bear market coming close to an end, do you have any thoughts on the 4-year cycle? Is this something that figures into how you think about, investing in tokens? Like it seems like something that it just hangs over the industry. And I do think it's a self-fulfilling prophecy. I do think there was serious investors that were selling in the fall, just assuming like, there it is, that's our 4-year cycle. And now we're going to get a 12-month drawdown because that's what's happened, 3-4 times before this. Aave V3 is now live on Mantle with a 6-month incentives program featuring 8 million MNT and 1.5 million Go in rewards. The Mantle market on Aave just reached $1.25 billion in total market size, while stablecoin supply surged to $1 billion, growing 120% year over year. You can explore Mantle Markets V3 supporting assets like Tether, staked USDE, and wrapped ETH at app.aave.com/markets. Puffer is building the ultimate vertical in crypto. Your crypto deserves better yields. Better yields require better infrastructure, and Puffer is building it. Puffer Liquid Staking delivers above-market ETH yields, secured with up to $5 billion in slashing penalty protection and buffer. Puffer Institutional offers compliant, secure, above-market ETH yields for DATs, institutions, and large players. Puffer Unify is the first synchronously composable rollup, enabling the next generation of app chains on Ethereum with sub-10 millisecond transactions. Unify AVS enables pre-confirmations, making Ethereum validators more profitable and rollups more scalable. Puffer is premier infrastructure and yield for digital assets. Stake your ETH at app.puffer.fi.
So I understand why there has been a 4-year cycle. And the reason why is because the industry is so reflexive. So it really has been a handful of assets going up, expanding basis yields, that leading to capital flowing on chain, that leading to revenue metrics that are very cyclical, and then money, kind of in a virtuous cycle. And then if everybody believes in a 4-year cycle, then and it's purely reflexive, then people will exit, reverse that process, and you'll go from rising revenue, rising prices, healthy basis to kind of a deflated basis, declining revenue, declining prices. So it makes sense why the industry has looked this way. I believe that this industry will not succeed unless we break out of the 4-year cycle. And the way to do that is very obvious. It's not about investors. It's about revenue growth. There's no 4-year cycle. There was no 4-year cycle in SaaS because the revenue numbers are going up and to the right. There is no 4-year cycle in kind of most technology revolutions because they're not reflexive assets driving all metrics. It's kind of like customer demand driving metrics, right? So, I don't think we'll see the 4-year cycle in stablecoins. To kind of give you the obvious example of this, when you have real demand from real customers, what you're going to see in stablecoins is just continuous growth with some volatility, right? Especially in the consumer use case of those stablecoins. So we need to graduate from the 4-year cycle to a long-term secular revenue growth cycle for this industry to be even remotely interesting 10 years from now.
Amen. I want to see that future. I want to switch gears here too, and something I want to talk about is MetaDAO. So we had Profit, the founder, anonymous founder of MetaDAO on our podcast. I think it was almost a year and a half ago. We talked a little bit about this before we hopped on today. And fascinating idea, like absolutely fascinating idea. And it was so cool and interesting, but admittedly, there's just so much going on in crypto. I didn't stay close to it. And so I think I've sort of lost a bit about what's going on. But what I have seen is, token price appreciation. And I wish, both DeFi Dad and myself bought the damn token after we thought it was so cool. But anyways, I'm glad you're here to sort of explain what is actually happening with MetaDAO, the bigger picture that seems to be playing out that, so many people are excited about. So can you kind of break this down for us?
Yeah. So MetaDAO is essentially a token holder protections company. So the way it works at a high level is when MetaDAO is an ICO platform. So you raise money through MetaDAO. And the way it works is that you put money into a treasury, and that treasury has a burn rate. Say it's 100K, right, for a company. So maybe they raise 5 million to have a 100K burn rate. That company will get 100K every month from the treasury to build this product. And it will give investors updates on how they're using the funds. And if investors lose faith in the business because the business isn't working, or the founder moved to Bali, or the founder is the business, the founder is kind of checking out and working on a new product or whatever, right? All the reasons that the tokens can fail in the space, they can take back to treasury essentially and wind down the business. So this kind of solves the problem where we've seen in ICOs historically that teams have basically taken the money and run. That's been the most common outcome of ICOs. Unfortunately, you can't have that situation with MetaDAO because the money is locked in the treasury, right? And also as part of MetaDAO, the teams get options that unlock after a long period of time based on financial performance. So there is the situation where teams are kind of like launching at a high FTV and unloading tokens into the chart, and then kind of soft putting the business, because you launch at cash value and you're only paid tokens as a team, after a number of years, if you were able to create a meaningful amount of value. So it kind of solves those two really perverse incentives that we've had. MetaDAO, a lot of people talk about futarchy, which is important. Futarchy is basically a governance system that I believe scales well to the internet, because DAOs have, in my mind, proven to not be an efficient way to manage businesses. And increasingly, crypto companies need to compete with fintech companies that are managed by kind of A+ quality teams. And kind of going through DAO theater and DAO politics is just going to hamper you. But the flip side of that is giving teams ultimate control, too much control, leads to tokenholder problems, because the teams kind of, have the incentive to do whatever benefits them and their friends at the expense of a distributed system of token holders around the world that they don't know, right? So I think futarchy and MetaDAO kind of solve this, because you allow the teams to operate within their bounds, right? They can manage the business. But when it comes time to a board of directors level decision, and we're talking about selling the company, we're talking about changing the buyback program or paying a dividend or changing CEOs, board of director level decisions in the US public markets, then you go through a futarchic market. And what that means is that basically the market speculate on whether the decision will increase or decrease token price. And that it just scales well to the internet, and it does something else, which is it makes the token the objective function of major decisions. So this actually has its historical precedent in the U.S. There was a moment where the Dodge brothers, who were investors in the Ford Motor Company, found out that Henry Ford was spending like 10% of revenue on charity and doing it for the sake, for his kind of humanitarian views. And they sued him, saying, look, this business, has external shareholders. You have a duty to us to maximize our profits. You can't use this as your personal charity. And the courts ruled in favor of the Dodge brothers and established the concept of shareholder primacy. And now every kind of public company CEO needs to make decisions that are justified internally as benefiting to public company shareholders, right? So even if you're going to make a decision, if you're going to approve an acquisition, you have to say this is best for the shareholders because of XYZ. If you're going to change strategies, you have to say, this is the best thing for the shareholders because of XYZ. And there's a lot of judgment that's allowed within those constraints, but it kind of set the stage for, the best capital markets the world has ever seen in the U.S. capital markets. And I think MetaDAO's futarchy system does the same thing for tokens. Because it says, hey, we have active markets. Your token is your objective function. You need to make decisions to maximize this price. And you can't just say that you're doing it. We're going to have votes. We're going to have, a vote is kind of a speculative contest where people decide where the token will trade higher or lower. And you have to listen to the market on whether your decision is accretive or dilutive. And actually, just to make that concrete, because it's very abstract, the Across proposal, they did not use futarchy, but I'm judging it through a futarchic lens. Because when they announced the conversion to equity, the token went up, right? So that would have passed. That would have passed in MetaDAO markets, in futarchy markets, because the criteria is whether the token goes up or down. In the Aave drama that we've been seeing, instead of having people pointing fingers and calling each other names, what we would have is a market that says, do you want this Aave proposal to pass or not? And the markets would speculate on whether that proposal would increase or decrease the token price. And you'd have the markets decide. And I'll say one last thing about markets. Markets have a skin in the game kind of mental model where if you're trading these markets, you are stuck with your decision. If you think that the price will go up, you're buying the token, literally. If you think it's going to go down, you're selling the token. So what you get is not people who have no skin in the game commenting on Twitter, being loud. What you get is people is kind of sophisticated actors who've managed to amass capital, betting their capital on the outcome. So you get much more sophisticated, much more motivated players analyzing these decisions and getting to the right outcome.
So interesting. I know from an angel perspective, we can speak to certain frustrations where you invest in a founder and they sit on that capital, they pay themselves a salary, they say they're building towards something, it never launches. You have very little oversight of how they spend that money. I mean, it's basically like their piggy bank. And that's a standard in the industry. We have very, very little leverage, I think, given the size of angels that we are. But I would argue that even the biggest funds in this space, they don't have the social capital to dictate to the best founders, what are you doing with your money? And so MetaDAO makes a hell of a lot of sense to me. I would love for there to be a better incentive structure for certain founders. Again, this isn't the bulk of them. I'm not trying to, paint some terrible generalization of folks who are building products, but they're failing. They're building products and the market conditions are extremely unfavorable for their product launch or their token launch. It's very difficult to build a startup in this space, but there is, I think you would call it white collar crime. There's nothing specific that they've done that we can go after them and say, hey, you need to wind down the business and return whatever money you have to investors. There's some who are just using the system, and I love what MetaDAO is doing. I think you articulated perfectly why it all makes sense.
Gold chain crime, because
yes.
These guys wear white collars.
Yes, yeah.
I actually spoke to a crossover liquid VC fund recently who told me that half of their VC investments no longer respond to emails. So kind of gives you a sense. I don't know if that's everybody, but this is, this was a smart person who does diligence. So
I've got one out there right now I've been trying to reach that has a live token and can't get a hold of them. Can't get a hold of them in Telegram or email. I've done everything short of tweeting at them or calling them out in a podcast, which I'm not comfortable to, but it's you assume the best in many cases. I know that folks are busy, but you start to question it when there's a track record of just no response, and you start to worry. And at the end of the day, there's real money at stake there. So I love MetaDAO ensures that you can't end up in a situation like this. And I think it moves the industry forward.
Guys, so we've spoken a bit about that VC side, and MetaDAO kind of bringing this new way to invest in a project. But I want to pick your brain, Felipe, even more about the liquid side. I feel like that's kind of your home. That's where you specialize in. And we've talked about, there's basically maybe no longer this buyer for narrative tokens, right? This marginal buyer that was buying narrative tokens is maybe gone. I don't think that's like fully true. I think we're just, we're always going to have some narratives that people latch onto, retail, or anyone just starts buying into that idea. But over the long term, that's not what's going to sustain. So I would love to just, again, ask you what Theia is looking at as far as, when it comes to fundamentals, when it comes to like the DCF stuff. Again, yeah, what are the things you're really paying attention? And you mentioned you're deploying in this market. Yeah, what catches your eye in a market like this, where we're at in a bear market?
Yeah, well, I think we have our kind of non-negotiables, which are Tokenholder is the value accrual instrument, fintech growth backable team, and by that I mean we don't judge our founders by the standards of crypto, which have been a little low for founders, but we judge them by the standards of kind of growth fintech. If this was a $5 billion round for a fintech company, or a $1 billion round for a fintech company that's growing 30% a year, would this founder make sense? Right? Because that's ultimately what we want out of all of our companies. Even though we don't always underwrite to that, that's the outcome that we want from everyone we invest in. And honesty and integrity, everybody says that. I think in this market it actually does disqualify a lot of people. And by the way, it's been a huge return driver for us to only invest in long-term aligned, honest people. And I can get into some case studies there because it's worth getting into those. And then good valuations, and good valuations relative to our predictions of the future, because valuations are always relative to a view of the future. So, in our view of the future, borrow lend protocols are good places to be. Like anything that's AUM based is a good place to be, if you're run by a thoughtful team with a real business model. And that's because what we've seen historically with the development of financial systems is that most value accrues to AUM businesses. One analogy that I use all the time is you don't know who founded the NASDAQ or the New York Stock Exchange. And those weren't exactly founded, so to speak, but you don't know who the CEOs are either. It's because those are kind of small companies, right? They kind of peak out at $50 billion. But most people know who the big bank founders, the big hedge fund founders, the big capital allocators who manage AUM are in each country. In America, everyone knows them, but also in every emerging market, who founded the top 3 or 4 banks, because that's where value accrues in financial systems, to the management of AUM, because it's a stickier business, and it's not high margin, so to speak, but you can compound it for many, many years. So we look at a lot of people you've had in the space, and we're kind of constantly underwriting and have owned names like have owned or do own names like Maple, Camino, Morpho, Aave, and the like, right? So companies in the AUM space, broadly defined. We also, in this market, we're getting a lot of really, really good valuation for things are trading at optionality value. I don't know. I don't have a better way to say it. Where you have businesses like Layer 3, which I'll give you an example, that's trading below cash value, right? Brandon is one of the best founders I know in the industry. They have this no loss lottery concept. That's a big idea, right? It's where you kind of put your money in, and instead of earning treasury yields, your yield goes into a lottery, so you can get a big payout, but you're not going to lose any money, right? You're just kind of losing your yield. People like this product. It's a big market in the UK. And the company's literally trading at less than cash value, and it's a token holder aligned business, right? And you're seeing a lot of those. Maybe I'll give one more name. Turtle Club is a business that we've been supporting for a long time. They are, they're trying to build a debt capital markets bank on chain. So if you go raise TVL, you speak to Turtle Club, they kind of help you through the process. We've always needed that in the space because it doesn't make sense that people need to kind of go to investors directly. Like you never see an industrial company in the US reach out to fixed income funds. They go to a banker and the banker manages the process. Turtle does that, and they do a lot more. I mean, they're building a whole tech stack around the process of connecting investors and projects, which again is just an obvious thing they need in the space. I mean, they have a public treasury that you can look at on chain at almost $10 million, and the market cap is at 30, right? So you're paying 20 for a business that's generating revenue and humming really well. We're seeing a lot of those types of opportunities where you're really paying small valuations for good businesses. So that's where we're spending most of our time right now. Outside, it's not so much thematic these days as like, I can't believe this opportunity is available at this time. So let's find more of these.
Yeah, and no better time to be looking for these opportunities than when we're in this like massive drawdown bear market, that we've seen in crypto before. This has always been a time that I do think, even though I'm not super comfortable when I look at my portfolio and what it's down from, but I am always excited for the opportunity to uncover and to invest into good founders, fundamentally sound tokens. I feel so much more comfortable in 2026 than 2025, which is weird because 2025, my portfolio was up a lot more, right? Yeah. I feel like there's real opportunity. To your point, if someone said, when was the best opportunity to buy in the past 10 years? I've been in crypto, I think almost 10 years. I'm like, well, sure. Like early 2017 would be incredible if you bought into some of the L1s. But second to that, I feel like right now the risk in terms of investing in this industry, there's as little as there's ever been, just because the industry has grown up. We have pro-crypto regulators, especially in the United States, which was always like a dark cloud over the industry. And to your point, the industry is waking up. I think that 2024 with meme coins was a really gross time, and 2025 there was still like a hangover from everything that had happened. But I think there's been a purge, and I think it's necessary in order for us to move forward.
Yeah, bear markets are where you make all your money, right? You just don't know it at the time. That's one of the quotes you live by, and the reverse is true too, right? Bull markets are where you lose the most money. You just don't know it at the time.
I need some help with selling the top of market, or just like taking a little bit more off the top than what little I did there.
I want to really go back to one thing I said before, which is just it's worth highlighting. We have really made an effort to partner with honest management teams that are long-term committed, and it's been one of the most important things we've done. Is having a really strong filter there, and I want to make the case for just tell the case study of Derive, because they are a good example of that. I don't know, Derive was formerly Lyra, the Opsis protocol. And Nick Forrester there, the CEO, he's been at it for 5 years, and he's had every opportunity in the world to sell his tokens, which have been unlocked for long periods of time, and quit, or to actually sell the business to people who want to pay him cash and rug the token, or to give up because it wasn't an easy path to wealth like he thought it would be. And I mean, this is somebody who traded options at SIG, right? This is somebody who has a very high opportunity cost. But because he is an honest, long-term aligned builder, he's gone through that entire period and is now having a moment where he's finding true product market fit after the Coinbase Deribit acquisition for on-chain options. And we've seen that happen many times, right? It happened with Maple as well, which I know is a friend of this podcast, where they went through kind of hell with the token and kept the token, decided to do whatever it took to make people money back, and is now doing better than ever. And again, we just seen that the people who seemed like they weren't in the industry for the right reasons are the ones that give up and lead to the worst outcomes. And the ones that are really long-term builders, eventually they figure something out, has been our observation.
Speaking of, I don't know if this podcast will go out before this other episode with Alchemix. We just interviewed Scoopy. We haven't talked to him in a few years at least. I've not had like a one-on-one conversation, and he fits right into this conversation. I am blown away by what they've been working on. I think they've been working for 2 years on this V3. They're going to have still the magic of the self-repaying loans, which I feel like they pioneered a lot of the idea of holding a yield-bearing asset as collateral, borrowing against it, letting that pay down your debt, over time. But they've got this fixed-term redemption that they've managed to design into the protocol. And so this is a founder who didn't give up, who I believe is like long-term aligned with this space. And just, it's such a cool story. Like, to your point, like whether we're holding a token or not, which by the way, we're not holding the Alchemix token. And so I feel even more excited to amplify the good work that they're doing. So just invigorating to hear all these good people, high integrity people who are building in the space for the long term. I want to pivot us just to RWAs for a moment. So I want to talk about, where do you see real opportunity in RWAs on chain, like RWA adoption on chain versus there's a narrative around RWAs. We think this is real. Again, it's cool to see something that deserves real attention, getting it and growing a narrative. But what are your thoughts on the RWA movement in this space?
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are 2 key things we need: deep liquidity and high yield.
To learn more, go to katana.network. Hey folks, I want to tell you about our sponsor, Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi.
Yeah, well, I certainly think it's real. And because it's real, it's going to take a long time. That's just the way of the world with financial markets. We've seen, kind of the what we call narrative RWAs taking some hold, which is like wrapped treasuries with tokens attached to them, paying high yield. And that'll always be the kind of first step in this evolution, right? Because that's what would scale quickly. But what we're seeing now in the market is just, again, green shoots of people really getting kind of niche parts of the auto loan segment on chain, or reinsurance paper on chain, or emerging market loans that aren't all adverse selection. And that's always a risk, right? With RWAs is that you can get adversely selected. We're seeing this pick up again and get done kind of properly at a small scale, lending to real estate for repairs. And the reason this makes sense fundamentally, and then, the biggest example is Figure with the HELOC market, right? Where the HELOC market is essentially fully an RWA market. It's not on permissionless blockchains, it's on the Provenance blockchain, but you can lend to US HELOC borrowers through Camino, right? These are all real green shoots in the RWA space. I think it will take a long time because you have to go and tackle each of these markets independently, right? And you're going to have all these issues with adverse selection. It's just a part of what we're doing here, where permissionless markets will lead to adverse selection, and you'll have what you had with Goldfinch happen a few times, where you kind of buy all this, oh, look how high the yield is on Mexican SMB, but guess what? The businesses don't exist. Or should have been paying a much higher rate because of the intrinsic default risk. But yeah, I think it's real. I think it's starting in earnest right now, and when we're seeing it on the ground. I actually do want to take that to one point, on that's I think really matters on RWAs. The constraint on RWAs and the constraint I think for the industry at large is not engineers, and it's no longer regulations. It is financially sophisticated underwriters. We don't have many of those in this industry. The reason we'll see adverse selection in RWAs, or we'll see blowups like we saw with Stream in Q4 of last year, is because people are not doing the work that you would do as an entry-level banker looking at these loans, right? We know people who did diligence on Stream, including us, that looked at it for one day and knew it was a fraud, basically, right? Those things shouldn't be getting to hundreds of millions of TVL. It shouldn't be happening. And the reason that all these, this goldfish era led to adverse selection is because people were not doing the work either. They weren't saying, hey, let me cross-reference these emerging market loans with public markets, even if they're not that liquid, to see if these yields make sense or if these stated default rates make sense. And the reason why is because we have like 100 people in this industry who do that type of work, and 50 of them made too much money to care about small opportunities, or maybe more, right? So I think it's actually solvable because there are a lot of people in the world who can do these things. There are a lot of bankers in the world. A lot of them are going to get laid off right now with LLMs kind of doing everything a banker can do. So I think it's solvable, but I think the main constraint right now is financially sophisticated talent that can look at these opportunities and say, this does not pass the bar. Because when you don't have those people, kind of, bad debt accumulates in the industry, and we get these big flush outs, and they can carry companies with them.
Yeah, and like speaking of doing the work, there's like never been more of an excuse for like you have no excuse not to try to do the work right now, because as you've spoken to, all the tooling that can condense these exercises into minutes versus days, it's sitting right there at your fingertips. And this sort of gets into something else you've written about, this idea of the investment manager of the future. You wrote an essay on this and basically talk how like a 4-person AI native fund is just going to be beating these $1 billion AUM shops if again, they lean into this stuff early and use all the tooling available. So maybe can you sort of tease out that idea a bit more?
Yeah, absolutely. So basically, the way that I see the past few decades of investment management, and this is very high level, right, is that there were major economies of scale to raising a $1 billion or $5 billion fund. And the economies of scale were that you could get an office in Midtown Manhattan, you could hire 10 Wharton grads that could build models and put together PowerPoint presentations, or 20, right? You could go to the Goldman Investor Day conferences, pay for those, meet investors, and say, "Hey, look at my Midtown Manhattan office. Look at my analysis. Look at my 50-page presentation." And then all those people are smart people, right? So they were getting deals that were, average or above average. They were getting deals that were average on average by definition, but many of them were above average, and they're smart people. And the reason the small funds have always existed, despite this economy of scale, is because there is a lot of alpha to being small, right? So a lot of the opportunities that we look at as a relatively small fund are these $1 million, $1.5 million, $2 million ticket size opportunities that a $1 billion fund is just not gonna do, right? Not gonna spend time on. And a lot of our best returns come from those opportunities. I think MetaDAO is an example. We built a position. It was a $20 million company when we invested. We built a position over a year almost. A big, like a $1 billion fund can't do that. And that's always been the case. Small funds have always had this kind of embedded alpha. But they were at a disadvantage with economies of scale. Now that disadvantage is gone because the LLM puts 1,000 analysts in your pocket. And you can now be producing 100 times, literally 100 times the output of a big firm with a 4-person team if you guys are on and you're focused. And you can have a small fund with 2-3-person team, 4-person team, and now you have both advantages. You have all the analysis you need at your fingertips, and you have the alpha of a small fund. So I think that is just the force going in reverse, where we're going to see a lot more of this passionate capital allocators with small teams who do a ton of analysis and look for these little nooks and crannies of alpha. And I think that broadly ties to my view of where this industry is going long term. So we discussed some problems, but ultimately I do think we're going to get to that world where we have hundreds of thousands of assets on chain, and you can have an on chain asset for, Brazilian auto loans or a hotel in Indonesia or any, all these are assets that have debt and have equity, and those are held by people around the world. And I'm just saying we're going to put it all in the soup, put it all on the internet. And what that world looks like is not, it's going to be a lot of LLMs trading these things, but I think it's going to be a lot of small teams who discover niches in small subsectors of the world and can earn higher returns. And just to complete the kind of vision, this, it's a speculative thesis, but I think it's approximately right. I think you'll also get fundraising natively through the internet. So, you guys have been around for a long time. D-Hedge tried to do this back in the day. MetaDAO is obviously an internet capital raising protocol. I think that we are not that far from a world where somebody can show returns, verifiable returns on chain, right? And an LP can give them capital on the internet, and they can manage that within constraints. And kind of, so instead of having this you look good in the suit and I saw you at Goldman 3 years ago, I'll give you money. You can have this all against all competition of managers saying, here are my returns for the past 3 years. Here's what I invest in. Let's have some calls, and then I can fundraise on the internet directly. It's a very much drag right thesis. It won't look exactly this way, but I do think that it points to the broad forces of where the asset management industry is going. Going smaller, it's going more niche, more alpha. After really consolidating in a few big players over decades.
So lately, we've seen a number of notable funds in the space, venture funds in the space that have, publicly pivoted away from crypto. Maybe I'm misframing it. Maybe it's they see opportunity. They see too much opportunity in AI. Paradigm has been one of them. What are your thoughts there? Is there any signal in that? I know we're comfortable continuing to invest and focus on this space. We see the opportunities that you're, calling out here with these high integrity, long-term focused founders, but you have to at least pause for a moment and think, okay, why are these folks pivoting away?
Yeah, I think there is a lot of signal, but it's a question of teasing out what that signal is. So there's a few reasons why I think people have been pivoting away. One is, too much money syndrome is always a problem in this industry, or not a problem. It's always a feature of the industry, right? It's a difficult industry to be in because it's so volatile, and it's not broadly socially valuable in the way that AI is, or even private equity is, right? We always make the joke that if you did a dating app, the same person is the founder of an AI startup versus being the founder of a crypto startup, they would get a lot more matches as the AI founder. And that matters to people, right? It matters to people who go to weddings with their wife and tell her friends what they do, and it matters to people who are single and looking to kind of start a family. And that won't go away until this kind of scammy nature of the industry is kind of put to bed permanently. That's what we're, everyone here on this podcast is kind of fighting for that outcome, focusing on fundamentals and tokenholder rights and the like. And so if you have too much money and you're going to go through another bear market, you might just say, I'm not going to do this again, right? I just have I'm comfortable. I think there's also the too much money syndrome at the fund level. If you're really big, I think you mentioned Paradigm. It's just hard to deploy a really big fund in the space because there aren't that many revenue generating businesses that are investable. LPs don't really want you to be investing in BTC, ETH, Sol and charging fees on that. Most people don't want to give back capital, so go to AI, right? AI is going to be a huge investment opportunity. You can deploy a whole fund in there somewhat easily, and it's exciting, right? It's exciting right now. It is truly a revolutionary technology, even though I think that's going to go through its own hype cycle at some level. But then I think the last point that's really relevant is this industry for the next few years will be a financial industry. That's consensus now. I think we've thought it since the beginning, but I agree with it. And financial investing is not always the sexiest thing to do with your life, right? It's like measuring PE ratios and ROEs and net loss ratios. Thinking about moats, in the context of like capital moats and kind of what's sticky, what's not. It's not nearly as exciting for people who came into the industry thinking about, replacing the world government and earning 1,000x returns on the future of the decentralized corporation and all these big ideas. Like this space for so long was big idea with 1,000x outcome attached to the idea, and that brought in a certain demographic. And now the industry, like I said, it's financial services investing, which is what I lived for and was born to do, and a lot of people are like that. And I'm very excited to do that in the most interesting period for financial markets, probably definitely in my lifetime with the revolution happening here. But most people just don't want to do that. And if you want to have big ideas and get 1,000x outcomes, kind of lottery ticket outcomes on big ideas, you're much more likely to do that in AI or robotics. And that was the demographic that we had here. If there was a bunch of financial service hedge fund investors here, they wouldn't be leaving. They wouldn't be leaving at all, but that's not what we had. We had kind of tan boys in the industry.
Yeah, and I think what you're speaking to and what we've kind of talked about through this whole podcast is like this industry is evolving. And I wonder too, as like an investor, okay, we're leaving a time when it was, sort of easy to find something that would go up a lot. But now we're entering this time where I think, as we've been talking about, everybody's going to be looking at these fundamentals. And I start to wonder, what is priced in now? What isn't priced in? Because I'm like, hey, if I'm looking at something and it looks really good, isn't everybody else looking at this? Like, holy crap, this thing's generating a ton of revenue and it's priced very, very cheaply to that revenue that they're generating. But I do think there's still inefficiencies in the market. Like we're not at this stage where crypto is totally an efficient market yet, but we're moving that direction. Anyways, this sort of brings me to some of the things I've seen you write about this. Just edge in general versus Brier scores. You've written a bit about this. Can you break this down for people like me that maybe don't understand what you're talking about?
Yeah, that's a piece we wrote about Brier score versus edge a while ago. Basically, Brier score and edge are two ways to assess the value of a prediction. So Brier score essentially measures how often you're right, and a lot of the prediction science uses Brier score, and the way to maximize Brier score is to say the thing that you think is more likely to be right, which sounds like the obvious thing to do, but I disagree. If you think the war in Iran is going to end in a month, you say it's going to end in a month, right? Or if you think it's going to snow in December in Boston, you say it's going to snow in December in Boston. We actually have a very different view of the world that's more linked to markets, which is you have to maximize edge. And edge is true predictions that deviate from consensus, right? This is a classic idea of being contrarian right, but edge is just a mathematical interpretation of it. And the beautiful thing about edge is that if you look at some of these John Kelly writings, he actually was able to prove that maximizing edge leads to the fastest long-term compounding of a portfolio. So it is just by definition the way that you maximize long-term returns is maximizing edge. But the reason it's interesting is it takes you to a different headspace when it comes to how you think about things. You're not saying is this right or wrong. You're saying how far is it from consensus, and if it's on consensus, it's not even interesting to think about, right? So in our investing, we usually try to stay away from really well-owned names. It's people consider it like a capital offense, but we're not in hype right now as investors. We haven't been in the past few months, and that's because that is a name that is consensus. People know it's a good company, right? We're in names like Layer 3 and Turtle Club because I don't know anybody else who's invested in those names. There's no consensus kind of thinking around those companies. And I think as we form opinions, we also try to say what are we wildly divergent from consensus here? And if not, let's not even consider this investment. And it doesn't mean that it's not a good investment. Things could go up and be fine, but it's just much less likely to be something that makes you money if you're kind of going with the crowd. And the last thing I'll say is I have a lot of debates about this with kind of regular friends from, college or outside life, where they'll usually go for the more likely outcome, and I'll usually go for what I see as the mispriced outcome. And I'll be wrong more than half the time. But my response is I'm actually getting way more edges than you because I'm right, somewhat often about the 1% or 5% outcomes. So if it was an investment, that's how you maximize your returns. And I think just generally, that kind of points to the last thing I'll say here, which is like everything is ticker, like everything is financial markets is like a worldview. So if you're having an opinion, there's no ticker attached to that, right? You're not going to actually compound. But why not kind of have that headspace of like, I'm going to make a prediction here. Treat it like a prediction market. Like, what's the price here? What? And then, how much do I earn if I'm right? How much do I earn? How much do I lose if I'm wrong on this prediction? I just kind of see the world as liquid markets, right? Like LLMs come out and PowerPoint skills are down 90%, right? And I think we all kind of get to this headspace being in crypto long enough, this kind of everything is ticker headspace. Galileo has his ideas and Ptolemaic physics goes down 99% over the next 50 years. Total divergence. But this is kind of how we think about the Brier versus Edge thing. It's kind of it's more of a way of life and a way of thinking about everything in the world than just one particular model.
One thing I just noticed, I think it was DeFi Llama had tweeted out a chart where it showed the dominance of the top 2 or 3 winners of like each sector. And it tells a pretty clear story that like the number 1 and the number 2 are just, owning, I don't know what it was, 50, 70, 80, 90% of a market or a sector of DeFi. How do you marry those two views? Because like I absolutely buy into your worldview here. Like that's what I'm looking for. I don't want to invest in teams that are already the consensus winner, unless of course there's a rare instance where I see the token as a store of value, and for me that has been ETH and Bitcoin are 2 of those that I'm comfortable to continue to hold and denominate in. But when I'm thinking about making that, next investment that is, 0.5% of my portfolio, I'm thinking along the lines you are. So how do you marry, those 2 views? Because I feel like they kind of go head to head.
Yeah, so the way I marry them is that first you make the prediction, and there you ask yourself, what is true about the world, right? And that's where the DeFi Llama market share graph comes in. What is true about the world is that it is much more likely in these markets for the winner to remain the winner. That's the base rate, unless you have a very good reason otherwise. And then after you decide what's true about the world, you ask yourself if your model for the world diverges from consensus. And so what I'm talking about is the second step, which is like, once you have your 100 kind of thesis about the world, you see which ones are worth investing behind. Not the first step. Do you never want to have a view that's contrarian just because it's contrarian? The question of whether a view is contrarian or not comes after you've determined the truth about the world. And people often mix those steps up, if that makes sense. Now, sometimes companies do take the first spot. So Hyperliquid took the first spot from DYDX and GMX, in kind of that order, in perps. And that's the best investment you could have made. It was hard to make because there was no VC, but like, had you had the opportunity to invest in Hyperliquid early on, that would have been the best investment. And people, I guess, did that through the airdrop. And then Morpho has taken the top spot in lending, and Compound lost the top spot in lending. So like these market share shifts do happen. And it's basically my point is like, if you're going to bet that something's going to keep the top market share, that can be an investable thesis, but it has to be because there is a reason why the token is cheap, or because you believe more in the market growth, right? Like you could have said Tether 4 years ago, look, I have an opportunity to invest in Tether. I think stablecoins will be huge. The market thinks there'll be 100 billion tops. I think there'll be 3 trillion tops. And that would have been a great investment because because you had a different view than consensus on market growth, right? Not just market share. Or you can invest in one to take market share, and those will be much bigger returns. But if you're kind of aligned with the consensus on, the winner will keep market share and the market will grow at consensus growth rate every year, like you're just not going to make money doing that, right? Because that's what's priced in.
Totally. I can give a real life example of where I'm kind of putting this trade on. And it's, if you look at borrowing lending, which we've talked about, obviously Aave, Morpho running away with the category, but I hold the Fluid token because I think there's a probability that Fluid one day could overtake those two. And I don't think that's maybe a high probability, but I think the risk reward is worth it. And, I have information I know about that team that I've acquired over many years, and we have an extremely close relationship with the team. And they check all those boxes that we've been talking about of builders that didn't leave, didn't run away, and they're in it for like literally the love of the game to build something transformational, right? So, that's just like one example of where, hey, that's probably not consensus. And hey, obviously Aave and Morpho are huge behemoths, but
the last thing I'll say, I think that is a perfect example of Edge versus Brier. Do you want to be right or do you want to make money? I'm kind of like, if you want to be right, you're going to say Aave and Morpho will be the market leaders in 3 years if you're maximizing Brier. But if you want to make money, in 5%, 10%, 50% of the time, your bet on someone who's going to take market share will be a home run outcome. And, depending on how things are priced and the probability, that's the way to bet because you're maximizing Edge, not Brier. But again, not always. You have to really think through the math and the asymmetry of each bet.
I think this is a great place, guys, for us to wrap up. So I want to remind our listeners that they should learn more about Theia Research by following the Twitter account, Theia Research. We'll put that into the show notes. But otherwise, thanks again for your time. We would love to have you back. Keep up the great work. I think we're all working towards a similar bright future for this space. But I want to give you the final word before we go.
Good. Thank you for having me on. I appreciate the questions. I've been a big, long time fan of the podcast. And as of December, I'm also a DeFi dad, so to speak. So it's good to be part of the club.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.